Sarah Ragusa from Platzer. I am thankful to everyone who helped make this possible and everyone who was kind enough to take the ride and jump on a morning call and help coordinate. I know it took some planning and all of that, so I appreciate it. I am a commercial real estate and finance attorney at Platzer. We're in Midtown Manhattan. I also practice in New Jersey. I do a lot of commercial lending work, representing lenders and borrowers in complex commercial transactions. I'd love some easy deals if you want to send those to me, but somehow I always get stuck with the hairy ones. So I'll take those too. I do a lot of commercial leasing work as well in the commercial and industrial space, office space. I can help with the due diligence process, from consulting with lenders, from the structuring of a transaction, putting together the commitment letter, all the way through post-closing, cleanup, follow-up, making sure that everything is tidied up in a nice little bow for the quality control team after. So that's what I do. Aside from that, I also have a passion for continuing education. It's like I'm a glutton for punishment. I find myself teaching a lot of courses, continuing education courses for brokers often, looking for ways to network. I think it's a great way to, sort of generate deal flow. I don't think that deals just happen. You have to be, part of making them happen. So I think that everyone who's on this call probably feels the same way. And that's why we're doing this at 9 a.m. on Wednesday morning. So for everyone, thank you for coming. I'd like to introduce our panelists. First, let me thank Siri and Sissy and Marianne. I know all the media and the reaching out, it takes a lot of time and collaboration. So thank you for all that you do to make that possible. And as Marianne said, we had an education call yesterday with the leadership team. And one of the things that has sort of resonated with me from since I was, I guess, like 20 years old, when someone said it to me, was I can put you in a room, so someone can put you in a room, but what you do in that room and what you do after you leave that room is entirely up to you. So today we're going to talk about some the impact of COVID on credit considerations, on being able to obtain financing if you're a borrower, on the different things that lenders are looking at and how to structure and meet their clients' needs. And I think that everybody in this room has a lot of insight to contribute to that. So again, for networking purposes, we have Wells Fargo here representing, the institutional lender. We have Piermont Bank representing like the alternative lending space. We have Robert Withers representing, the broker's point of view. And I think you'll help give a full picture of the dynamic of the stress that sometimes goes into making everyone bend a little bit so that no one's entirely happy when they walk away, but a good conclusion was reached. And I think I'm rambling. So because we all know each other, I think there's some deals that you'll have to pass up on that maybe it just doesn't fit your box, but there are other people in this group who may be able to take it. So while you may sometimes think of each other as competitors, I think, it's a source of referral because sometimes something doesn't fit in your box, it fits in someone else's. So without further ado, I will introduce first Tracy. Tracy is with Wells Fargo. And Tracy, introduce yourself, introduce your team, and then we'll move on to Robert.
Great, thanks, Sarah. Good morning, everyone. I'm Tracy Parker. I am at Wells Fargo. I'm a credit team manager, managing a team that underwrites deals for the Hudson Valley, New York City, and Long Island. With me today, I have John Hetsko, who is a market credit leader. So he's one of our in-market credit approvers. And Joe Polliciono, who's a commercial banking team lead running one of our sales relationship management teams. Throughout COVID, our big focus has been how can we support our customer base while still protecting the bank? We've really wanted to be there to help our customers through this, while at the same time looking for new business, which has been a little challenging, and we've had to find a really different way to go about that. So we're all very excited to be with you today and look forward to learning more about each of you.
Tracy, that's a good introduction and exactly what we've been striving to do during the last year. I'm Joe Polliciono. I'm the commercial banking leader in New York City, responsible for a team of relationship bankers whose focus is getting our client base through times like this and helping to service them and grow with them with both an array of credit and non-credit products. And also we're responsible for trying to grow Wells Fargo's market share in Manhattan and convincing as many clients as we can out there that we're the best bank for them going forward. So I look forward to talking about how we've managed through the past year because it's been an interesting one.
John Hetsko, I'm the market credit leader in New York City, working with Joe and Tracy. My role is the credit authority. I'm the approval officer for deals within my authority. Deals that go above my authority, where I'm a recommender up the chain. The good part about the way we're organized is that I'm within the same business unit as Joe and Tracy are. So we can make credit decisions very close to our customers and allow that real direct communication with the credit side of the approval authority chain.
Thank you, guys. Robert?
Great. Rob Rynarzewski. I'm the head of commercial real estate for Piermont Bank. Piermont Bank is a de novo or challenger bank. We just opened for business in July of 2019, right before the pandemic kind of started. We're the first de novo or challenger bank in New York since the last financial crisis of 2008. So, if anybody has questions of how to start a bank or the regulatory approval process and how long that takes, that's a whole nother conversation for a different day. But, relaunched the bank, like I said, opened in July of 2019. We were a little fortunate in the sense of maybe didn't have the legacy or portfolio issues that other lenders had. So, I'll be able to speak to and provide, our approach of how we've, tapped the market and looked at new opportunities to build the bank and build the portfolio over the last year, which has been extremely challenging.
Thanks, Robert. Rob Withers?
Morning, everybody. Thank you, Sarah, for the introduction. Thank you, Sissy, Ziri, and Marianne for the platform. I really appreciate your work in putting everything together. Like Sarah introduced, I'm Robert Withers, and I own and run M1 Capital Corp. We are a boutique commercial mortgage brokerage with locations in White Plains and in New York City. We specialize in permanent financing, which is more on the conventional side, utilizing lenders such as Wells and Roberts Bank. We work with private financings, utilizing private equity real estate funds, or in some cases, even individuals who lend private money. And we also do some commercial debt workouts. So Bill, I'd definitely be interested in speaking with you and honing in on your expertise. We find ourselves really busy right now in each one of those categories. We're busy on the conventional side, a lot of SBA financing for owner-occupied properties, and we find on the conventional side for investment, we're utilizing agency financing, Fannie and Freddie. On the investment side, we're doing business with banks like Roberts. Small regional banks who understand the real estate market and understand what's going on and how to deal with credit considerations during COVID, and have a comfort factor in the area that they work in. I guess my perspective is an interesting one because I'm squarely in the middle. I'm used to doing business with banks like Roberts and also banks like Wells Fargo, and clients come to me to make the decision on who to go to. Because they might have a deal that's really best fit for one or the other. So that's my perspective, and I look forward to the discussion today.
Thank you. All right, so now that we know the people in the room, my perspective is a commercial lending attorney and a commercial borrower's attorney. So, trying to deal with the negotiations of the loan documents and the covenants. It's like, well, you got a term sheet. Those are the covenants, and once we got to know what your deal was a little bit better and things got uncovered, we're going to have to impose some more. And sometimes that's like very difficult to stomach on the borrower's end. But at the same time, it's sort of managing, well, how much is overprotecting? Because some of the worst things that can happen is when, or at least in my opinion, is when the lawyers over lawyer and it makes a deal completely fall apart just because you weren't thinking outside the box on how to get the same protection for your client in a way that's a little more palatable for their needs. So I think with our team at Platzer, we have a history in bankruptcy. We have a very strong workout department. We have a strong commercial litigation department. And then we have, loan origination and our transactional department. So we're able to really discuss with one another, okay, how can I be flexible with this to protect the bank, to make sure they're covered, protect them from the bankruptcy scare that, it's like looming over everyone's head. How do I keep the bank safe while still being able to give the borrower the flexibility that they need to continuing about their operations without feeling that they just signed their entire life away? And sometimes the answer is, well, you're going to feel like that because you really need the money and your financials suck, right? So sometimes that's just the reality of it. And you have to just spit the truth and tell them and manage their expectations. And I think that's so much of the relationship between the lender. And sometimes it's telling the lender, hey, here's what other lenders are doing right now to deal with this situation. And because we have the experience representing various different lenders, we sort of get to see how other banks are doing it and how we can potentially, make a situation that seems a little bit complex, a little more palatable for everyone. So having introduced everyone, when we were brainstorming, topics on what would be the most relevant sort of discussion relating to credit considerations, we came up with a couple of questions that we thought were worthy of, diving into. So setting expectations, as I started, is sort of the beginning. So I'd like to just touch on, whoever wants to sort of jump in first. When a client comes to you with interest or you're proposed, so usually it's going to be with Robert, right? Robert Withers, a client comes to you, they have cash needs and they're looking to, leverage their assets for it. You have to set their expectations. So you're going to really take a look at their financial package and you're going to create a narrative for them, essentially, to sort of pitch, right, to these lenders to see if they're interested in the deal. So tell me, what's your process and what goes into sort of setting the expectations for these borrowers when they come to you? What's something that a borrower should be aware of and come to you with to be able to move forward?
Sure. Thanks for the question, Sarah. When I first take a look at a transaction, I'm within about 5 minutes. I can, with a series of questions, and it's usually around the collateral, of course, most importantly, the cash, if it's an investment piece of property, which let's just say it is, the cash flows of that property. I do a lease abstract. I understand the lease, the way that the leases are set up, the historical expenses on the property, where it is, and sort of the borrower's profile, their experience, that they've been a good borrower in the past, that they've been able to borrow money in the past and they've repaid it, most importantly. I guess within the first 5 or 10 minutes, I can gauge who would be a great target lender. We call them target lenders at our company. And I basically set the profile for 3 of them. and I put out a bid or a loan scenario to 3 of the lenders that we believe would be a good target lender for this transaction. And we do that in the form of an email. We don't overpaper our lenders to begin with, and we wait for a response. And that response usually has to come within 48 hours in regards to some sort of an idea of how financing would be structured. I do prepare the client for a few things today. Number one is on an investment property, expect a period of time, an elongated period of time to close the transaction. You know, where we were able to close commercial transactions, let's say within 60 days, that's probably more like 90 days now. And it's just the due diligence, the reports, you know, a lot of things that go into it, even, you know, sometimes even on the legal side, that has to be factored in. I do prepare them also for interest rate reserves. A lot of borrowers are surprised that, you know, lenders now are looking for a 6-month or a 12-month interest rate reserve to make sure that debt service is taken care of on the when the loan closes for the first 6 or 12 months. That's just a factor that we're dealing with now, and it's not going to go away, I don't think, anytime soon. You know, obviously on mixed use properties that have a retail component, it's understandable. So probably all the professionals on the meeting today, but who are attending today, but to the borrower, sometimes they don't understand it, especially if the retail component is performing, you know, so that's an issue. And I also prepare them for a lot of questions. Lenders, let's face it, and I'm sure Joe and Tracy will chime in. Lenders are asking a lot more, and Robert, they're asking a lot more questions today, you know, and just get used to it. It's just the way it's going to be. They are crossing the T's and dotting the I's even more than they were before. So I hope that answers your question, Sarah, but that's pretty much what I'm seeing.
Absolutely. John, Joe, Robert, anybody want to chime in? Tracy?
Yeah, I agree with a lot of what Robert said. I mean, I think, you know, we like to think we've always dotted I's and crossed T's, but certainly it's heightened some of our communication protocols and making sure we're getting information in a real-time way. You know, the way we communicate with clients changed. We're doing a lot more Zoom than we used to do. But the communication protocol and the expectation around sharing information is an important difference. I think, and from a structural basis, a lot of our deals today look very similar to what we were doing pre-COVID. I think the credit culture at Wells Fargo is one of being really consistent through you know, boom times and sort of recessionary times. So I think that side of it has been good, but certainly in heavily impacted segments of the market, like the office and retail world, you know, there's been some increased reserve activity to you know, offset the potential for vacancies, which has gotten more real in the current world.
Yeah, I think you're right, John. And we always historically thought we dotted our I's and crossed our T's, but none of our downside scenarios ever envisioned what would happen last year. Yeah. So we had situations where clients were devoid of all revenue. Some were impacted less than others, but we really had to think about who do we support and how do we support them. And one thing we did look for was we were going to support clients and people that also help themselves. So we were more than willing and are still willing to do more than our part and more than our share in supporting clients through this. But those clients that also help themselves, whether that's through changing their business model, whether that's through taking 11 of their relatives off the payroll at $1 million a year, whether that's reducing lease payments that they made to a real estate company that they owned themselves. So we were so happy with the way clients adjusted to the new world, and I think we came through this. If we sat last March and thought, how would we deal with 12 months of COVID? Would we want to be on the other end where we are today? We'd say absolutely, because our clients adapted. I think we as a bank have supported them correctly, and hopefully we've turned the corner and we can get back to some level of normalcy. But as Robert said, We did ask a lot of questions. We did require more reporting. We did ask them to explain their business more. We did require projections. So we may not at times have been the easiest people to talk to, but I think that we managed to incorporate all of that information and come out the other side with support for the clients that we wanted to make sure got through this challenging year.
And now, thank you, everyone. Now, Robert, with Piermont being a new bank, and I don't, you're breaking into the industry in this time of COVID, and you're sort of competing with these other banks that have these relationships. Obviously, you don't have the, failing portfolios in some instance because it's new bank. But did you feel like you had to compete, like require a little less in order to be able to, get the deals rolling?
Yeah, sure. Great question. So, I think for us, it kind of all stems with the sponsorship and integrity of the overall sponsors. For us, it was really, truth and transparency over the last year, and that becomes even more critical in our credit underwriting process, in the sense of, we know that every asset has a story over the last year. It can't be the rosy picture of, yep, everybody's paid on the first of the month, no issues, and otherwise, it wouldn't be an opportunity for either us to come in and refinance, or you wouldn't be looking to tap the credit market. So for us, definitely more questions asked, more due diligence up front. And for us, it's really, with the truth and transparency at the beginning, it's building that custom suit or tailored suit in a loan in order to kind of build something and build a loan that the borrower is not going to trip themselves up over the next 12 months to 36 to 60 or even 10 years. How can we build something together that not only works for the bank, but works for the client and their business strategy and the asset as well. So for us, Zoom and Teams meetings became even more important, because it was sitting down with clients, with our team, to say, what's the story? What are you trying to do? How do we need to best structure the bank and the loan in order for a positive outcome for everybody moving forward?
Robert, I admire you in that in a lot of cases it's difficult to open an account at a bank these days, and here you are opening a bank.
Yeah.
Congratulations. That's terrific. And I think you reinforce something that I've said for years, and it's that we lend to companies, but in reality we're lending to people. And the last year has given us a real great glimpse as to how people will behave during challenging times, and making sure you're choosing the right people that you're lending money to is as critical as whatever covenant or whatever financial statement you receive.
Absolutely. I mean, I'm not gonna, sugarcoat. We've definitely had clients that come in and say, yeah, things have been tough. We've had, this tenant on 1 month, and then we get further down the due diligence process, and it's like, okay, well, show us where they've paid you, or they're backdated and your workout plan. And it's, well, maybe they haven't paid a month, but now they haven't paid in 6 months.
Right.
So, it's truth and transparency and knowing all the facts going in. Like I said, to kind of custom build that loan that works best for everybody. If we find out in the 11th hour as we're going through our verification process that, collections haven't been what you've said, that throws a wrench in everything.
Rob Colorina, I saw that you had.
Yes, thanks, Sarah. Good to see you again. And apologize for joining a little later. I'm actually in Utah on a visit, so I'm in Mountain Time. We're equity investors in 20 states and 24 countries in manufacturing, real estate, and technology. And we've been Wells Fargo clients, corporate clients in the past. My question is interesting. With the new bank model, And then I guess in the incumbent financial institutions, the concept of resiliency, of understanding both portfolios, and Robert, was your bank sort of chartered during COVID, and that
Yeah.
you were able to address, because I think one of the things I haven't heard much is about a PPP and COVID stimulus phase, how you deal around that, including the phase outs. And I'd be interested to hear from the new perspective and from the incumbent type banks, how you all are treating your that environment with your clients.
Sure. I mean, I can start. We're lucky enough, I guess, in the sense that started the charter process about 2.5 years before actually opening. That's about how long on an expedited basis it is to get a new bank charter. Myself and the executive team all come from larger institutions. So, we like to think, and the FDIC likes to tell us that we were fast tracked at 2.5 years, which was pretty daunting. But, especially your question in regards to PPP, we were extremely active. We were probably more proactive with our real estate developers, reaching out and saying, who are your tenants? Can we grow the bank that way? Who needs help? Because if we can support our developers and the people that we rely on for repayment by helping those who they rely on for repayment, hopefully that strengthens the overall relationship and at the bottom line, our overall balance sheet. So, we think in the first round, we did, over 500 loans, PPP loans. And, a lot of them are still out there. We were active in the third round as well. So we continue to support them today. So PPP was a primary focus for us, especially on the SBA side over the past year.
And Joe or John or Tracy, how about for Wells?
We were also very active on the PPP front, and we've continued to be active during this phase. And I don't have the numbers in front of me as to how active we were, but the numbers were mind-boggling in terms of the money we lent out. And we've worked with our clients and trying to navigate that process, which was not easy at times. But I think one of the interesting things about it was that any of the fees that Wells Fargo collected from the PPP program, we designated to philanthropic efforts and across the country. And I think we were able to forego about $300+ million in fees and put it back into the communities that we're in. So, and also in helping our customers, that was terrific. But I think in also making a statement to the country that we're behind them and we're going to support them through this pandemic. But it at times has been challenging for clients because it's not the easiest process to navigate. But we've been trying to hold their hand through it, and I think we've been real supportive.
And how has the fact that your clients, your borrowers, have received PPP loans, how does that go into your underwriting? Like, does it at all? Do you discount it? Tracy, do you have any input on that?
Sure. We certainly look at the PPP loans, and we're trying to understand on a go-forward basis, what is the cash flow, what does the financial operations of our company look like? And for many of our clients, they're sophisticated, so they went into it having a very good sense for what was going to be forgiven. But of course, we're a large financial institution, so when we're doing our analysis, we're really looking at it from the most conservative perspective. What if it doesn't get forgiven and they actually have to pay this back? How does it look? And for the most case, the borrowers have a plan for that as well, and they're prepared to move forward. The other piece of this is looking at our existing covenant packages. And with the PPP funds, it changes the leverage profile, ideally temporarily. And we've been looking at that and deciding, do we need to make a change to these covenants? We waive them temporarily, and trying to be as flexible as we can to make sure that we're supporting our borrowers in the right way through this, recognizing that the PPP program is a great opportunity, and we certainly want to help them benefit from that, in any way that we can. and where we have to pivot a little bit from the way that our structure has been underwritten in the past. Where it's appropriate, of course, we're going to do that to support the client base.
Thank you. Now I know so managing expectations, anyone else have anything on that? Any, of our attendees have any input, any questions on that front? No?
The one thing that I want to add is we focused a lot on the companies that were experiencing difficulties through COVID. We actually had quite a few customers that were doing really well, and business essentially exploded during COVID, depending on what industry they were in. So it was important to manage expectations for those borrowers as well, and show them that, yes, overall the economy is not doing so well, but we're here to support you. And as you have this explosive growth, if you need additional working capital funds, we're here, we want to support you. So it wasn't always just about, looking at the line and whether they really can support that capacity. Sometimes it was, can we bridge you to the next phase? And do you need more debt? Is there some way we could be stepping up on that front? And, looking forward, all this explosive growth, do you expect that continue? Or do you think it's going to be a 1 to 2 year time frame and then things are going to, fall back to historical levels? And just working with the companies to help them understand that and plan for those as well.
That's right. We've had a number of success stories for companies positioned well during the pandemic, and we look forward to continuing to support them and then also support the clients that are coming out of it. So it's been not only challenging, it's also been rewarding in that we are helping clients grow during this period also.
Sarah, I think Tracy makes a very good point. It's important to manage expectations both on a positive and a negative view, because I'm doing a lot of work right now out east, East Hampton, Southampton, and those areas, and they're target areas right now, right? They've grown exponentially during COVID because a lot of people have moved out there temporarily, and those who have homes there have been working out of their homes and just wanted to get out of Dodge. That's not going to always be the case. So when you're financing both spec financing out there, although it is an insulated market and has historically done well, or you're buying an investment piece of property in that area, I've seen lenders take a step back, at least some of the lenders I work with, and say, okay, that's great, but can you maintain this growth? Will you be able to get these lease rates going forward? Will the summers be that bit much more, as busy 2 years, 2 years forward? I still have lenders who hit their loan calculations with the 10% vacancy factor, and that's very aggressive. And I think, the lenders will agree with that on the call today. But they're insistent upon it because we don't know what is around the corner. Those areas could peel back, and there could be issues if properties were not leveraged in the correct way. So I agree. You have to take a look at both sides.
Great, thanks. Now, we spoke about increased costs and time potentially associated with, additional reporting. So maybe, a borrower who wasn't doing, audited financials, or, who wasn't getting reportings on a monthly basis, but rather quarterly. If things have been increased, there are also those associated increased costs with some of the transactions right now. And of course, time, just because you're asking for more, you're asking more questions, it's going to take a little more time. I certainly on my end have seen, things have just slowed down, and, we'll go to committee for underwriting, and then, you think you have a good package, and then they start reading, it's like, well, what about this? Then, you get sort of kicked back, and then there's like another week goes by, and then it goes back, and it's like, okay, good, you answered that question, but what about this? So one of the questions that I always get is, why isn't the credit committee taking a look at the package and giving me all the questions at once so I can just answer everything? And it's like, well, sometimes what you're giving me just raises another question, right? But why don't the credit people sort of chime in on that? When you're looking at a package, why aren't you just giving me a full checklist of everything you need to be answered? I know it seems like a ridiculous question, but please.
It's a fair and common question, and
Yes.
you know, we do our absolute best to do that and to make the you know, client experience as good as possible. You know, the realities of an unprecedented shock to the system, like what 2020 was, is that there can be some, you know, it can be dynamic, and some of the questions, you know, can change with time. And you know, we as a bank had to be more fluid and flexible, and you know, we expected some of that from clients as well, in terms of, you know, this what we were looking at in the market changing, and new questions coming up that hadn't been there a week or 2 weeks before. You know, there's always, you know, it's a common upfront question is how long will it take to close, and you know, that timing hasn't changed in a panacea world where everything is here complete and clean. You know, we can still close transactions quickly, but that panacea world became less and less likely, and certainly there were some extensions on the time frame as a result of that.
And Sarah, it's a competitive world. So if we're asking too many questions, or we take too long, or we're unreasonable, or we don't understand the client's industry, they have alternatives. So we pride ourselves on trying to do as much of that up front. We have a seasoned group of relationship managers. We've been around a long time. We've seen a lot. So we'd like to try and make that process as easy as possible, and also use it as a competitive advantage that we can be quicker, we can be more responsive. And I think that one of the challenges in this Zoom world is we can't get in a room and show our expertise, but I think we can hopefully convey that in the best way possible and be as responsive as we need to be, because the marketplace will keep us in line. If we as a bank get unreasonable or too demanding, there are alternatives out there.
Absolutely, that's a good point. So, oh my goodness, we only have 8 minutes left. So let's hear from our audience. What's our attendees, participants? Put out your question. You know, what do you got? I have other questions, but I'd rather hear from our group.
Bill? Right now.
Question. Good.
Yeah, I got a question for Rob Withers. Rob, on when it comes to workouts or forbearances, I can tell you in my travels, I'm asked almost daily from every creditor out there, what are you seeing in the marketplace in terms of bankruptcies, workouts that fail? I hear the expression kicking the can down the road. I'm just picking on you because you mentioned about the workouts, one of your specialties. Is there stuff that you're doing in the workout area that you sit there, you say, you know what, we're going to be talking about this in another 6 months. It's just not going to make it. Is there some percentage or some gut feel that you have? You say, you know what, this actually could work out, but I got to be prepared for when the shoe drops in 6 more months or a year. Whatever. And what sort of you seeing? What you seeing in your ends? You're muted.
Exactly what you just said, Bob, and thank you for the question. And you know, I like Bill's perspective about this also, because he does this full time, I believe, is what he said. And but what we're seeing right now, from some of the clients who have called me and said, I'm on my second forbearance. You know, things are starting to get heated with the bank. You know, we're not on such great terms any longer. We're starting to see people come by the asset that we don't recognize, you know, like it could be they could be sending by an appraiser or somebody just kind of get a feel of where value is and, you know, what the physical condition of the property is. But I think we're 6 months to 12 months away from seeing a big hit in regards to applications for modifications, which would be the first, and I think Bill will probably agree, will be the first sign of issues that are on the horizon. And obviously, you know, and Bill, you can please jump in. The first play here is a change in in payment, right? You want to probably go to some sort of a payment relief before you start looking at other things like extending terms or principal balance reductions. And we'll start probably seeing that in the beginning parts of it. So more, a conversion over to interest only payments so that, maybe there's not so much principal payments, changing covenants, things of that nature, which are all part of it. But I think we are 6 months to 12 months down the line, and we're getting geared up for that. We have a marketing platform that we've invested in, and you'll start seeing stuff out of our company more geared towards workouts in the months ahead.
I think Robert nailed it. I think we're 6 to 9 months away from there's been so much uncertainty, right? So that's what you're hearing from credit and everything. So you've always had to sell a credit, right? You've always had to have champions, right? You have to have the loan originator. Once you get the credit, you have to have a champion for the credit then. So you have to make everybody happy kind of along the way. And with this great unknown of last year, I mean, we were talking about 12 months ago, right? So 12 months ago, we had no idea where we would be sitting today. And right now, what I'm sitting at looking at, I work with closely held businesses, and the problem they have is they have too much cash. They are sitting on bucket loads of cash that has just been doled out by the government. There is so much money sitting in. I'm sure Wells Fargo sees it. You have to see your deposits up and these business deposits up. They're tremendous. They have received this windfall frequently and don't even have an idea what to do with it right now. It's going to get liquidated. People are going to spend it correctly, but many people are going to misspend it, and it's going to be the ones that misspend it the most that you're going to hear from first, or that already had something else kind of going on. You're already kind of getting some tickles of that in the economy. It's been so good, and with all of this uncertainty, stuff shakes out. When somebody's been doing something wrong, right now is when a chip doesn't go the right way and everything's unveiled on them. And you're starting to see some of that, but I really think we're 6, 9 months away from really starting to see anything happening.
Yeah, I actually take that cash hoarding as perhaps a positive signal from a good customer that says, you know what, I'm not sure where I'm going to be in 6 months. I don't want to be having this discussion with my creditor, next week or whatever. So let me just sit on this, and it will get spent. So maybe that's a good thing. That's the way I'm looking at it.
Well, hey guys, Bill and Bob, since you're buddies of mine, Marianne, I think one of the interesting things here is in terms of this cash hoard, whether it's a corporate or whether it's a family or an individual, I think one of the things here, I'd be interested to hear some of the panelists comment or attendee comments, is there's some attractiveness toward laziness. And, I think folks have been taking, for instance, unemployment versus actually working. And, there's going to be sort of a scar or gap in creativity or productivity that that some of these organizations are going to have to deal with. I saw John and Robert kind of shaking their head. What do you guys, do you agree, or am I in Mars in this thought, an observation?
Yeah, I mean, from our perspective, I can't tell you how many clients we've seen take PPP funds and, almost the exact dollar amount is matched in our account and growing on a month-to-month basis. It's, they took it because they viewed it as free money, and if they didn't need it, they could always pay it back. But in the meantime, if somebody's giving it away, they'll take it and they'll sit and wait to deploy at the right time. So that's what, we've seen a tremendous amount of that.
Yeah, I can't speak to the individual consumer side and unemployment and that side of it. On the corporate side, there was 2020, there was a big move towards preemptive draws on working capital lines of credit and putting the money in the bank. So we would have the draw on the line, and then we'd have the larger cash balance. Now we have seen a lot of that start to even out. We've seen some of those borrowings come down and some of that cash start to normalize here in recent periods, which I think is a good sign that a lot of businesses and business owners are seeing more visibility into the future right now. But there was a ton of that activity last year.
Mm-hmm.
Is anyone seeing that the small and medium-sized companies are barely hanging on? It's basically because of the PPP, the extensions, and it's an artificial bubble Band-Aid that's happening right now before the additional defaults occur?
There were a few. So, I mean, the PPP was a great program in terms of providing bridge liquidity for companies that were in a short-term position. Now, I think this didn't end up being short-term in a lot of industries. And as that's extended, the PPP benefit has worn off over time. And those more heavily impacted segments, are burning out of PPP and looking for the next source of liquidity or bridge financing. And those are the tougher situations. But there were certainly a lot of places where PPP was perfect. You had a short-term rent deferral or something like that from the tenant base. PPP bridged it to the other side of it. And now you're back to normalized rental income streams.
I specialize in, I'm sorry, go ahead, Bill. I specialize in the litigation and workout department of our firm. And what I'm seeing now is that as the PPP is running out and the extensions are coming due, the smaller and medium-sized firms are now starting to default on a more regular basis.
Yeah, so, yeah.
Anyone, I don't care. But Bill was talking before, so I was going to let him chime in.
Sorry, Bill.
It's encouraging kind of to see that you're seeing that already. The banks I'm talking to, a lot of these portfolios are very, very clean. I am definitely see they're spending it down. What I started to say earlier was there are businesses that I see that I'm looking at today doing their cash flow forecasting that clearly would not have made it through without receiving the PPP. Now they're sitting on a bucket load of cash. So it was definitely the right program. Somehow it kind of all shook out, but it's. Right now, I am very, very surprised to see so many small businesses sitting on so much cash. I've never seen small businesses with much cash at all, and right now it's substantial.
Well, don't you find that surprising that the companies that utilize the PPP are the companies that necessarily needed it? The ones that are sitting on it, obviously they didn't need it to keep employees, to keep the employees employed. And keeping a lifeline for the company to move forward for the year or the 6 months until the PPP funds ran out.
And one of the questions we always ask historically is, what is the company's reason for being? And I think we're going to have to ask that even more so going forward and evaluating those clients that we're going to support aggressively through challenges and through growth is, what's their reason for being in the post-COVID world? And that's something that we'll have to evaluate differently than we did in the past.
Sarah, do I have a moment for a comment? Okay, good. Just a comment to everybody around. I have a very good client who has a building in Mamaroneck, New York, who owns a very, very successful Chinese restaurant. Actually, it has two, one in White Plains and one in Mamaroneck. Him and his wife run the restaurant, and they took a rather large PPP loan. They qualified for it. They had a large staff. They took a rather large one. His business, Sarah, in the beginning, we had talked when we got together about repositioning, right? Repositioning real estate. It also goes for businesses. His business changed. It became all takeout. And it became to the point where he was doing phenomenally by jettisoning half of his staff, if not more, cutting down on his payroll, but his profit margin shot up through the roof because he was doing all takeout, and that's what people wanted in the area. He's sitting on this PPP money and not using it because, number one, he doesn't know if he's going to need to pay it back, so he doesn't want to spend it. And number two, his business changed. His business actually was one of those positive stories where it actually became more profitable. I think you're going to see a lot of that. And I think, there's going to have to be a repurposing of this money and a federal sort of addressing it, because some of the, how do I want to say, COVID benefits, there was no benefits through this, but some of the things that happened through COVID were business change. The business models of a lot of businesses changed, and it was for the better. So, and then how does that money get addressed? Thank you.
Well, thank you, everybody. If we don't have any more comments, I feel like we could probably go on about this topic for a long time. So we'll have to set up another one so everyone can come and keep talking. But I'm hoping, hopefully I'll be able to see most of you people in person soon. I know, Rob, I'll be seeing you soon.
Absolutely.
So that's exciting. But thank you everyone again for taking your time to be here this morning. Thank you for all of your input. I know, everyone wants to know what everyone else is doing, so we can all know if we're, how are we placing in the market? Are we doing the same things? How can we get competitive? But thank you. I appreciate you putting out the insight.